Welcome to this week's edition of Macro Minutes. I'm Head of Trading, Mark Gardner. The information summarised in this webinar does not constitute financial or professional advice. It's general in nature and doesn't take into account your specific circumstances. It should not be acted upon without your full understanding of your current situation and future goals. All right, stocks in our universe this week. We've got Rio, NAB and Raise Capital. On the 29th of July, Rio updated the market with its release of the first half of the calendar year. Management highlighted how the company continued to face challenges related to the labour shortages and increased diesel costs. Costs were about 4% above guidance due to the aforementioned factors. This was flagged in the quarterly update. Rio was broadly in line with expectations on revenue, net income, earnings per share, experienced a slight miss in EBITDA, but met the dividend per share expectations. As Rio's share buyback program ramped up, which is a positive for shareholders of a large diversified miner, especially as Rio shareholders tend to buy Rio primarily for dividends. The DPS of US $5.61 a share implies a dividend in Australian dollars of 7.6. A dividend of 6%, 8% fully, well, if you include the franking. Looking ahead, CapEx spending is expected to be around $7.5 billion for 2021, 22 and 23. Furthermore, the price of iron ore is expected to fall as Brazilian supply comes online. That iron ore price did drop through the 200-day moving average last week. For those of you subscribing to the trading department stuff, that you would have received an update on that. It's pulled back about 35%. Most of these companies didn't really go with the iron ore, particularly things like Fortescue when it was at those high levels, but they have managed to make hay while the sun shines. So it's currently sort of sitting at about sort of 6-month lows in that iron ore price at pretty key levels. So we wouldn't really want it to go too much further from there. Next up, we've got NAB. 30th of July, NAB announces plans to buy back $2.5 billion worth of ordinary shares on market. This comes after ANZ's announcement last month. The Zappa announced capital relief for deferred loans. The buyback is the most prudent, fair and flexible method to return capital in the current environment. I think ANZ was around about $1.5 billion actually. A lot of them are expected to follow suit. Buybacks expected to reduce NAB's Tier 1 capital by 60 basis points from 12.4 as of the 30th of March and sits well above the APRA's benchmark of 10.5. Management intends to manage its common equity Tier 1, the CET1, towards a target range of 10.75 to 11.25. Previously, they announced the sale of MLC Wealth to IOOF, as well as other items. That means NAB's expects to have pro forma March 2021 level 2 CET1 ratio of 12.15 upon the completion of the share buyback program. They expect to commence mid to late August with the buyback. The timing of the program and the number of shares will depend on market conditions, share price and other considerations. Next up, we've got RZI, or Raise Invest. On the 4th of August, they updated the market with their performance from July. They revealed strong results across the board with significant acceleration across many key metrics. This is because the numbers from its recent acquisition of Superstate, a $9.5 million acquisition earlier in the year, were included in its metrics for the first time. Management cited that the acquisition will allow the company's user access to residential property as an asset class. As a result, the company highlighted that Superstate added $71.6 million to superannuation funds under management for a 70% increase to $181 million. In addition, the acquisition managed to add an extra 6,000 customers to the Raise platform. Total FUM increased by 4.5% to $900 million. Operations in Malaysia and Indonesia remain on track, with customers increasing about 9% and 10% respectively. They outline even without the FUM contribution of Superstate, RZI was still on track to reach that $1 billion by calendar year end. If anything, they're ahead of schedule there. There were some worries about COVID, Indonesia having what was even worse than India at its height on a percentage basis of rates of infection, but it doesn't seem to have affected the sign-up rate over there. Market reacted really positively to the update, even without the super estate contribution metrics have outperformed the required CMGR hurdle rate. So up around 191. Trading department was pretty unlucky. We were looking at buying before the unexpected quarterly update was provided in late June around 155. It's since rallied, I think, traded at a high of 195. From what I can remember, we've got a target price potentially around the 220 mark, but that can obviously change. It does tend to drift off without a lack of news, sort of in the middle to late end of the month. So there could be a buying opportunity come up again around the 170 mark at some stage, which obviously has its risks, given that we missed the buyback in this month, and it's had a pretty decent rally. So that is a pretty thin stock. So be cautious there. Rightio, next up we've got the trading department stock of the week. So we were talking about those iron ore prices there before. So the stock of the week this week's Fortescue. They gave a great quarterly update just before the iron ore price started to come off. As you can see there, roughly about a week and a half to 2 weeks ago, we had the price peak around about 26.50. Since that point, iron ore prices have started to come off, but they basically have had extraordinary result in terms of how much they've shipped, how much they've produced. They managed to keep their costs under control, unlike Rio, and even though there's been bad weather in the Pilbara, they've managed to ship a record amount of iron ore. So, look, the share price has just been following the pullback in iron ore at the moment. It's gotten to the point where, realistically, with the upgrade to FMG's performance and outputs, in relative terms to the fall in the iron ore price, Fortescue is getting very cheap down here around these $22 marks. So we've got a recommendation here to buy around about the 22.25 mark. Currently, it's around about the 22.75 mark. Be fairly happy to if you've got a strong view on on a bounce in iron ore, to be buying anywhere under $23 really, or under $22.50. It could be a bit of a rocky trade there for a little bit, but overall, at these levels, it's representing an 11% yield, and it's good for the trade setup that we're going to get confirmation of those quarterly updates in the full year update later in the month, and a dividend. So I can't imagine it's going to be down here for long unless the iron ore price really starts to break down even further. But like I said, it's already down about 35% as it stands. I mean, how much more realistically is it going to go before the Chinese start stepping in and scooping up as much as they can? There has been a bit of a slowdown in China. However, look, the weaker commodity prices actually might start to kick things along there. We are worried a little bit about the Delta variant, but I think the world is slowly coming to the end of its patience with dealing with the economic cost of COVID. So I think we'll get the vaccination push and probably start to move past that. So the risk-reward ratio there's 2.42, and look, you'll get a tidy little dividend out of that. And buying pullbacks in this thing, as you can see from the charts, been pretty profitable in the past. Rightio, stocks to watch out for in the week ahead. We've got CBA, Goodman Group, and QBE. So these will all be reporting. We have started reporting season. We've seen a couple of names so far. The US is primarily through theirs now. So with CBA, it's expected to report its full year result on the 11th of August. It's the only bank reporting in the August period. Shareholders of the financial company should expect the performance of CBA during the reporting season to have a large impact on their positions. We expect CBA to report strongly in deposit and credit growth figures. The bank's seeing its market share grow in housing, household debt, personal and business loans over the past 6 months. Analysts are expecting revenue growth of 1%, net income growth of 13.5%, net interest margin of 2%, CET1 ratio improvement by 176 basis points to 13.36, which again is well above that 10.5 region from APRA. positive outlook on the Australian economy in the coming year means that, and beyond, means that the required loan loss provisions are expected to fall by 74.5% to 645 million, which helps contribute to the full year dividend of $3.56 per share. With that, it represented a 19.5% increase on the previous year, a 4% dividend yield in a single payment. So the bank's returning to their dividends now, which is going to obviously attract a few. They are at pretty lofty prices, above $100, but and with the COVID lockdowns, etc., we could see a bit of a pullback in the property market. But the government, whilst very disorganised at the moment, obviously has a very vested interest in getting this vaccination rollout done and dusted. Otherwise, they'll be walking into the next election extraordinarily unpopular. So next up, we've got Goodman Group. They're releasing results on the 12th. The largest property group in Australia, and they focus on development and management of industrial real estate, warehouses, logistics and distribution facilities. They've enjoyed an impressive financial year, 2021, 41.5%, as the industrial property space grew in attractiveness due to the effects of COVID, which accelerated the digitisation trend that increases demand for warehouses and distribution facilities. It's a trend that's expected to take away from industrial REITs in the long term as operating online businesses becomes more viable. They're expected to enjoy a positive reporting season, with FFO per share forecasted to grow 0.64, EBITDA to grow by 8.8, NPAT up by 14.4, which would support a full year dividend of about 30 cents per security. Ongoing trend towards industrial properties continues into next financial year and beyond. The completed development of new industrial assets should see these figures continue to grow. We had CIP also report yesterday, pretty similar overall. We've either had one or the other or both of these on as recommendations for the investing department for the last year. So it's been very, very good pickup by the research department there. CIP is currently around about the 382 mark, and probably expected to have the same tailwinds as GMG going forward. So there'll probably be switches over the course of the next year between the two, depending on the share price fluctuations. But overall, both are pretty acceptable for any portfolio currently with our outlook. Next up, we've got QBE, another stellar recommendation from our investing guys. I think, as most people will recall, we had it as a pairs trade with JLG. Both have ended up doing extraordinarily well. They're expected to report their half-year results on the 12th as well. The insurance business is expected to update on several key metrics, including GWP volume and pricing, and its attritional claims ratio. Although no guidance was given, management expects premiums rates to continue to increase. A bit of a shocker for insurance, basically, for the last few years, but QBE's managed to excuse the pun, weather the storm quite well. They're expected to update the market on this capital management policies, strategic initiatives, after cutting the dividend last financial year. Financial year 2020, that is. QBE expects to resume dividend payments with a 65% payout ratio target, which is in line with the company's historic targets. Brokers predict QBE's payout ratio will fall short of its target, estimating a final dividend of 30 cents per share, which represents a 60% payout. Nevertheless, we believe the balance sheet consolidation during COVID, which has seen the APRA PCA ratio improve to 1.73, management will actually follow through. So we're expecting a upside surprise there. Looking for an improvement to the combined operating ratio from 104.2 reported in February as a CAT claims normalise and rates rise. We have had a couple of hawkish central banks commentaries from Bank of England, a few Fed members, and the RBA didn't reverse their decision to taper bonds when we had the lockdown, which was widely expected. So it's probably fair enough to see, to see that we're still on track for rates rising, end of next year, maybe early the following year. We expect QBE's COR to improve by 1.6 PPT and NEP to grow by 14% in financial year 21. Dividend ratio, as we said, was 60% is payout ratio is expected. And the earnings per share and dividend per share estimates are 50 and 30 respectively. So yeah, look, a lot to digest there for reporting season. Make sure that you you guys keep an eye out for the updates from our research department. Maqro's historical track record over reporting season is quite exceptional. So, and it is a very important period, twice a year. So make sure you're keeping up to date. Make sure you're looking at your portal and checking your emails, because you know, you can make or lose a lot of money in these periods by you know, not being diligent with your orders and things. So if you're concerned about anything, obviously speak to your broker, or you know, or keep abreast of all the updates. Now, looking ahead, we've got US inflation data and the OPEC meeting. Yeah, so next Wednesday we'll have monthly CPI data. This accounts for the majority of the overall inflation. It's the same. Yeah, at the same time, we've got the CPI core data, which filters out food and energy inflation, which are historically more volatile. The following day is PPI. It's obviously just the producer price index. It's probably a bit more of a leading indicator. They're not too worried about inflation at the moment. If anything, they're worried about the China slowdown and the US slowdown. Tonight's payrolls numbers will be absolutely key. We're expecting 870,000 jobs to be added there. Rarely have I seen too many figures above 1 million. From my perspective, I'm really concerned that a number below 500,000 could really rock the market. So there is definite risk there in that figure tonight. And it's very unlikely that, you know, we're going to get anything above 1.2 million, because it's quite an enormous number. They can be quite volatile, those payrolls numbers. So it's definitely one to be wary of, and I dare say you'd be taking some risk off the table overall on a Friday. Has been recommended in the before the bell daily update from trading. So we've also got OPEC plus meetings coming up. Last month's meeting was a bit of a debacle. There was a dispute between the UAE and Saudi Arabia in relation to the supply agreement that binds the UAE, and saw prices rally, then quickly reverse. Oil's been off in the last sort of 3 or 4 days, probably pull back, you know, about 6 or 7%, mainly on Delta variant stuff. Hopefully they've got their ducks in a row this time around, and there's no continued conflict, because it did result in a postponed meeting last time. So yeah, there's obviously going to be a little bit of risk with the oil price, you know, with this meeting potentially, if they continue this little squabble that they're having about outputs. So that wraps up the macro minutes for this week, and we will speak again next week.